Hi, everyone, and welcome to Lessons on Loans. Learn how loans work before borrowing. So before we get started, we're just going to introduce our facilitators for today. So my name is Johnson Atalig, and I'm an academic tutor here at Project PROA.
And my name is Calia Lieto, and I am a college mentor here at Project PROA.
Okay, so today's presentation in a nutshell. So today we're going to dive deeper into the world of loans. We're going to learn a little bit about loan basics. Then we're also going to take a look at taking out a loan, the impact of taking out loans, as well as some helpful resources that you can use if you decide to take out a loan. So now we're going to go into loan basics. Okay, so what are loans? So a loan is when a lender extends a set amount of funds to a borrower. So in this case, a lender would be whoever is providing the funds, and a borrower would be whoever is loaning or borrowing the funds. In exchange, the borrower agrees to repay the loan with an interest in a set amount of time. And oftentimes, all of this is laid out in a loan agreement between you and the lender. Okay, so purpose. So let's talk a little bit about why we take out loans. So loans have many purposes. Loans help individuals who may not have a large sum of money upfront to cover major expenses or big ticket items, such as cars, homes, or land. And in other cases, loans can help individuals who are experiencing financial emergencies and they may not have cash or money upfront to cover these financial emergencies. Furthermore, it also allows for growth in the overall money supply in our economy. Okay, so now we're going to talk a little bit about the types of loans that we can get. And the very first one, and possibly a very important one to many of us, are student loans. And student loans, just as the name suggests, is money that students can borrow to help pay for school associated expenses, whether it be tuition, room and board, books, stuff like that. And there are pretty much two types of student loans that you can get. The first one is private, and the second one is federal. And the main difference between private student loans and federal student loans is that private student loans are provided by banks, credit unions, and other institutions, and federal student loans are provided by the government. Okay, and the next type of loan are personal loans. And a personal loan is an amount of money that you can borrow to use for a variety of purposes. It doesn't specifically have a purpose, such as some of the loans that we are going to discuss in the next slide. But it's just loans that you can take out should you run into a financial emergency, just as I had mentioned before. Okay. The next type of loan is auto loans, and auto loans are secured loans that are used to buy vehicles. And in this case, the vehicle is used as collateral. And collateral is basically a type of security that is used for the repayment of a loan. And if you fail to pay for the loan, the vehicle in this case is forfeited back to the lender. The next one is a home mortgage, and this type of loan is used to finance property or buy homes. And very similar to auto loans, if you fail to pay back a home mortgage, the property or the home is used as collateral.
Okay, so now let's go over taking out a loan. So first, we're going to talk about the things to consider. So before taking out any loans, there are a few things to consider and ask yourself, such as, do you meet the requirements to qualify? What are their interest rates and are there fees associated with the loan? What is the length of the loan and how do you plan to pay it off? So first, with requirements, the basic requirements to take out a loan are usually that you must be 18 years or older, must have regular income, and must have access to your financial information, specifically your credit score, because lenders are usually looking at that. And then with interest rates, they usually vary on how much you're willing to pay each month. So if you're willing to pay a small amount, then you have a higher interest rate. As compared to if you're willing to pay a higher amount, you have a lower interest rate. And then with fees, certain loans might require you to pay a service fee, or usually, most likely, they'll require you to pay a penalty fee for late payments. And then the length of the loan and how you plan to pay it off. So first, you must base your repayment plan on your income. So if you need to pay low amounts each month, then the loan will take a longer period of time to repay fully. However, if you choose to pay higher amounts each month, then your interest rate will decrease and you'll be able to pay off the loan faster. And then next, we'll get into the borrower responsibilities. So as you borrow loans, you are responsible for different things like communicating with your lender, making payments on time, and repaying the loan fully, and providing true information on your loan documents. So first, with communicating with your lender, it's usually expected that you communicate if different circumstances happen, such as if you're enrolled into college and then you choose to withdraw. And then you also communicate with them when you're having trouble with payments or things like that. Because if your lender knows, your lender could possibly reduce or postpone those payments. And then make payments on time. So even though they didn't send you a reminder to pay your monthly repayment, still make those payments, because usually those reminders come in late and it's just in case you haven't paid anything yet. And of course, you repay the loan fully and always provide true information and your information only. And now let's get into taking out a loan. So this is the actual process of taking out a loan. So number one, step one, know your numbers. Number two, choose your lender. Number three, accept the loan. Number four, spend your funds. And number five, pay the loan back. Okay, so getting into it, step one, know your numbers. So how much will you need? How much can you pay monthly? And what is your credit score? So only borrow as needed. If you need 1,000 to pay your car down payment or whatever it is, then only borrow 1,000. And then how much can you pay monthly? Usually it depends on your income. As I stated earlier, if you receive, let's say, $600 a month, then maybe pay $200 to your loan or something like that. And then to find out your credit score, if you're unsure of what it is, just make sure you review your credit report and then run a credit check. And keep in mind that lenders favor higher credit scores, and they could possibly give you lower interest rates. And then low credit scores might disqualify you. And then step two, choose your lender. So there are different types of lenders. There is your personal bank, such as maybe First Hawaiian Bank or Bank of Hawaii, or a local credit union, which here on Saipan, our local credit unions are usually our personal banks. And then there are mortgage brokers. Mortgage brokers are kind of similar to your bank. They offer the same rates and the same amount of loans. It's just that mortgage brokers usually charge service fees or additional fees to the loan. And then online lenders just helps you to do things all online and not have to step out of your house to go borrow some money. And yeah, so these different types of lenders, it's based on what you want. If you want to not have a service fee, then go to your personal bank. Or if you don't want to step out of your house and receive the money, then find a safe and secure online lender. Then next, step 3, accept the loan. So you must accept your loan after you fill out the loan application and attach your supporting documents, such as your proof of income, which could be your pay stubs or your tax documents, as well as your proof of residence, which can be your credit card statement or utility bill. And then you wait for your approval. So the approval process of most lenders will usually take 24 hours, some less, some more. And then accept your loan. You can either accept your loan money through checks or through direct deposit straight to your account. And then let's go on to step 4, spend your funds. Use the funds for its specific purpose. Again, if it's for your car down payment, only use it on your car down payment and spend it right away. And we advise you to do this because it avoids interest buildup and it prevents from spending the funds on different other things that will end up causing trouble in the future. And then finally, step 5, repay the loan. So for this slide might seem very minimal, and that's because my other partner, Johnson, he will be explaining further of the repayment of loans. But I just want to put this slide up so I could remind you that when you're repaying loans, just be sure that you repay them fully and on time without any reminders and right away, so you could avoid interest buildup and things like that.
Okay, thank you very much, Calia. So now we're going to move on to the impact on future life, or what happens after we take out a loan and how it can affect our future lives. Okay, so it's very important that we understand repayment. Many loans are repaid using a series of payment, and this is really discussed within your loan agreement between you and your lender. And this will tell you when you need to come in to pay and how much you need to pay. You also need to keep in mind that when you are repaying your loans, you'll be paying back both the principal balance or the initial amount that you borrowed and any interest that accrued on that balance. And if you want to pay less interest, your goal would be to complete loan repayment as soon as possible, because the longer that you pay for a loan, the more interest accrues. Okay, and last one is to keep in mind borrower responsibilities. And this was something that Calia really stressed in the previous slides, is that you need to keep in mind these responsibilities, because when you take out a loan, there are certain things that you are responsible for. Okay, so now we're going to talk a little bit about refinancing. And refinancing may be an option into repaying back your loans. And it basically involves taking out a loan to pay off a loan. So you would take out a new loan to pay off your current loans that you are currently paying for, right? And essentially, what you are doing is that you are starting from the very beginning. But sometimes refinancing is not always the appropriate thing to do or the smartest thing to do, because many times refinancing is done to improve loan terms. As we mentioned before, the terms of your loan are discussed between you and your lender when you make a loan agreement, right? And many times other lenders would offer you better terms. So it's the smartest thing to do to refinance so that you can get better terms on your loan. However, you also need to keep in mind that there are some risks when refinancing. One of them is that sometimes it does affect your credit score. When we're taking out any loan, not just loans for refinancing, if you take out any loan, and I'm pretty sure that Calia mentioned this before, is that it will affect your credit score because they would have to check your credit report, and in turn that lowers your credit score. Okay, and these are just some links that we would like to provide to you that you can use in your loan journey. Should you need any resources, we encourage you to check out these links. And most of these links are also to some of the banks that are available to you on island. Okay, and we want to thank you very much for watching our video. We ask that you please fill out our activity survey. The survey really does help us to provide you guys with quality activities. And we also want to, get your feedback on what you would like to see in the future. So once again, we thank you very much for your participation, and we'll definitely be seeing you guys in future activities.